Once you've got a reasonable grasp of the definition of an expense, it's relatively straightforward to grasp an understanding of the definition of revenue. And as we have with expenses, there are three criteria that we need to satisfy in order to classify a financial item as revenue. So firstly, it either has to result in an inflow of an economic benefit, which will usually be cash coming into the business, or savings of an outflow, e.g. a discount. Second criteria is it's either got to result in an increase in assets. So for instance, when the business receives cash from a cash sale, the bank balance goes up, or it will result in a decrease in liabilities. So for instance, when you receive a discount from a creditor for prompt payment. And thirdly, apart from capital, it has to result in owner's equity, capital being the exception because of the entity principle. So when justifying why a financial item is revenue, make sure you identify the three criteria and link them to the actual scenario. So criteria number one, it will result in an inflow of an economic benefit in the form of an increase in assets and an increase in owner's equity, satisfying all three criteria. In this case, the increase in assets is the debtor's control balance, and the increase in owner's equity is, of course, the net profit, the inflow being ultimately the cash that you will receive from that debtor. A discount, on the other hand, will result in a savings of outflow, criteria number one satisfied, resulting in a decrease in liabilities, criteria number two satisfied, and a simultaneous increase in OE, criteria number three. So in terms of the link to the actual scenario, the actual discount results in a reduction in the balance owing to the creditor's control for that prompt payment, as well as a simultaneous decrease in net profit. So it results in a savings of outflows, meaning you will ultimately pay less cash to the creditors, which is the whole point of paying promptly. So when justifying why something isn't revenue, again, go through the three criteria. So criteria number one, it will result in an inflow of an economic benefit in the form of cash that will be received from the debtor, and this will result in an increase in assets. The debtor's balance does go up with the GST component of a sale, but it doesn't increase owner's equity. So in terms of the definition of revenue, it doesn't satisfy criteria number two, and two criteria out of three isn't good enough. So in terms of actually justifying that decision, explain it like this: the GST charged will be collected on behalf of the ATO. Thus, it represents an obligation to an external entity, in this case the Australian Tax Office, that will result in a sacrifice of an economic benefit. So it actually satisfies the criteria for a current liability rather than revenue.